Reyes, Certified Financial Planner and Orlando's own financial quarterback, and welcome to another episode. We're going to piggyback from last week's episode on tax diversification. We're going to talk about tax-deferred accounts. Now, what is a tax-deferred account? Well, basically, it's your 401k, your traditional IRA, your 403b, your 457 plan. These are accounts that are set up for retirement. They allow you to put your income into these accounts. They grow inside of the accounts tax-deferred until a future day when you start withdrawing the money. Now, the advantages of these accounts is obviously that the federal government doesn't recognize that you got this income while you're accumulating and putting money in. However, they're gnashing at the teeth to get into these accounts because these accounts do often become problematic over time. And I want to take a look with you at the basic math of why they become problematic over time. And it's important that we not only plan for them while we're accumulating, but also plan for them right when we're distributing. And quite often what happens is that most people are lopsided in these accounts because they're offered to the employer provides matches, and so on and so forth. But let's take a look at the simple math of how these accounts work and the problems that you have over time. First of all, it's a simple math, so let's take a look that you're putting in $5,000 a month into these accounts. Your employer is also putting in contributions, so for all the time, let's just plan that you're going to put $9,000 a year into these accounts. So you're putting in $9,000 a year into these accounts for 30 years. That's how long you're going to work at 6%. So over that time frame, you're putting in $270,000. Now you get a tax savings because the federal government doesn't make you recognize the money that you're putting into these accounts. But remember, you're doing it during your accumulation years, so you have your most deductions and expenses during those years because you have kids, you have mortgage deductions, and so on and so forth that you're using towards getting your income taxes lower. So let's just say that you're at a 15% tax bracket or 15% tax, which means that you saved $40,500 of this money by using a 401k. Now let's see what happens. So over 30 years, that $9,000 a year grew to $712,000. Not a bad pot of money, okay? That $712,000 is now you need to take money out because you need to live, all right? So we're going to use an example of 4% a year. 4% is a rule of thumb, not a great rule of thumb, but that's what we're going to use for our example. So you take out $30,000 a year. You do that for 30 years, and you drop dead after 30 years. So over that span of time, you took out $900,000. However, remember, that's the time that you're now retired. All you have is pretty much income. You don't have a lot of deductions in your tax return. You got your house paid off. Other than maybe charitable reduction and maybe some medical deduction, you don't have much, okay? So now you're paying higher taxes because now that's compounding with your Social Security that you're receiving and income from all the other places that you're receiving. And now you're at a higher tax bracket, and we're going to say you're at 25%, okay? Now the taxes over the 30 years on that $900,000 equal out to be $225,000. But here is the problem. So you've got to save $40,500 in order to pay $225,000. Now, do you understand why the federal government is dying to get into these accounts? Because of that tax right there. Okay? And we're not even, this is just a tax that you're paying while you're taking the money out, okay? This doesn't even count the tax that your kids and your beneficiaries will pay when they start taking the money out. And maybe even compounded by the effects of estate taxes. In any way, shape, or form, what it's important to understand that we have to plan for this, okay? Because this is a compounding effect that becomes worse and worse and worse, all right? So we need to plan for it. If we can plan for it before retirement, great. If not, then we have to plan for it during retirement in a way that allows us to minimize this amount right here, okay? So with that, I tell you, thanks for watching, and I'll see you next time on Financial QB TV.